Our next guest says sticky services inflation is a problem that the Fed just can't shake, but he doesn't think today's CPI report changes the Fed's plan to start cutting rates sometime this summer. Jason Pride is Chief Investment Officer of Private Clients at Glenmede. Jason, welcome. My notes indicate that you think many of the most important markers in the economy, macro-wise, are moving back towards normal. What does that mean for equities then?
Well, thanks for having me on, Tyler. Look, we've been through a fairly long period of abnormal that started with the great financial crisis, we had, Brexit, we had European debt crisis, we had a pandemic, we had a long period of near 0% interest rates and inflation below 2%, actually averaging about 1 to 1.5%. This has been a really long, unusual stretch of time that the markets and the economy have been through. And the latest, say, year and a half is actually looking more normal than we have seen since the great financial crisis. So I think that's something that investors can begin to be more constructive about, particularly as we proceed through the rest of 2024, which we think is probably the last mile in that transition back to normal.
Does that return to normalcy augur well for equities?
So it can eventually augur well for equities. I think our starting point's a little bit high in terms of valuations. And this inflation reading that you mentioned a second ago, look, it's the last mile of any effort, right? If you're going for a run, last mile is obviously the hardest mile for you to get through in a run. Well, that's probably about the same for the Fed in getting inflation down to their target level. They made a lot of good progress down from 9 to 10% down to, say, 3-4% that we're kind of bumping around in right now. To get down to 2 is going to take a little bit more effort, and I think that's what we've got to work through in 2024.
It's been quite a long race. If you've ever run a marathon, the last 6 miles are actually really hard to get through. Jason,
I don't do marathons. It's 5-mile stretches.
but I would like to ask you about your thought about services staying sticky. I know that the airline prices were higher in the CPI report, but if you've been to an airport, demand is sort of unrelenting. I mean, the lines are incredible. It seems every time you go, whether it's a key weekend or not. How much trouble is that for the Fed when you're looking at the price of services?
So I wouldn't say it's an alarming trouble, but it's something they're going to have to push against as we go through the 2024. When you pull apart CPI, food and energy was actually effectively down and has been for the past 3 months. So have core goods. Shelter's holding high, but we know what's going on there. It's that other thing, this core services, excluding shelter, that's actually been so sticky in nature. And the fact that we're still running in like 6.5% range. Look, I think the Fed would like to see that number settle in at 4, right? That 4 number would probably mean core CPI or overall CPIs probably in that 2 to 3% range. 4 is a sustainable number. 6.5 is not what they would like to see in terms of core shelter X services. I think it's very much underpinned by wage costs in that equation. And until we get a little bit more constraint in the labor market, we're probably going to be facing tougher numbers there, which it's what makes it so sticky and hard to deal with. It's kind of like that gum on the bottom of your shoe.